Let's get started. Good afternoon, everyone. My name is Stan Van Nieuwerburg. I'm a professor in the finance division here at Columbia Business School, as well as the co-head of the Paul Milstein Center for Real Estate. And today it's my great pleasure to welcome Gilles Dellaert with us. Gilles is the global head of Blackstone credit and insurance business. We'll talk a little bit more about his background in a second, but just by way of introduction, prior to his current role, he was the global head of Blackstone's insurance solutions. And prior to that, he was co-president and CIO of Global Atlantic Financial Group. Before that, he worked at Goldman Sachs in the reinsurance group, which became Global Atlantic when it got separated from Goldman Sachs in 2013. And prior to that, he was in Goldman Sachs' credit trading business and with JP Morgan. Welcome, Gilles.
Thank you for having me.
On a personal note, Gilles and I actually go way back. We went to the same high school in Ghent in Belgium. We also went to the same university, University of Ghent, where we both studied economics, just a couple of years apart. And here we are 30 years later, both of us having spent the last 20 plus years in New York City. So that's where I want to start, Gilles, like taking you back 30 years, all the way to your Ghent days. So tell us a little bit more about that part of your life as a student, and maybe also what part of that experience shaped you in a way that you think now or was instrumental for your present-day success.
Sure. It is pretty fascinating. I think this might be the first time that two Belgians are sitting in these chairs or in this room. You led the path because I think you were 2 years or 3 years ahead of me. Look, I think Belgium is a small country, and while Ghent was kind of like a main hub for learning for us school-wise, I came from a very small village, and my parents were of limited means, but always instilled, I think, just simple values of hard work in me, and I wasn't very interested in economics, to be honest with you. I was on a kind of competitive snowboarding track, which is rare in Belgium, but my dad pulled the plug and said, you have to go study. And I reluctantly signed up for economics because I felt that was like open-ended and would give me a lot of different options. It wasn't until I took a class on markets in maybe my final year that I became pretty curious or interested, or something sparked in me the interest in studying market structure, and that was mostly around bond markets. And so I worked in a small financial institution, interned there in Ghent, a bond trading business. I sat on a bond trading desk and became fascinated with fixed income markets and the kind of confluence of macro and fixed income, was highly intriguing because every day you walked in, something was happening and it was unpredictable, and the trading aspect of it, I kind of became somewhat addicted to at a relatively young age. I then moved to JP Morgan, who had a business in Brussels. Back then, before the introduction of the euro, you needed to be a dealer in the local currency or in the local market. They had two people working there. One traded government bonds and one traded credit. And I was their desk assistant, if you will. They sent me to New York for training. Did that training program here, across the street from my office now, actually, and worked there for a year. And my boss left to Goldman Sachs to go build what was then the early days of credit derivatives. And I joined him, and the rest is history. So, kind of stumbled into insurance in 2007, and that was definitely not a cool place to be. Right now, it's evident that insurance is like at the cross section of credit markets and all the alternative asset managers. But back then, it was a relatively new phenomenon. And so I think the arc of it is the journey is not evident in retrospect, right? Nobody, when we were sitting in Ghent, would have thought we'd be here. But somehow, through luck and happening to be at the right place at the right time and being open to trying and doing new things, I ended up here.
Yeah, it's a fascinating journey for sure. So tell us a little bit more about those interim years between arrival in New York and the Blackstone chapter.
So I think I was lucky that I had 7 different jobs in a relatively young age. and that I always came about because I think whenever there was a problem or an issue or an opportunity, I kind of always said like, I'll help. And whenever I did, they were like, oh, okay, why don't you go over here now? And you fix this, why don't you go over there now? And to me, I'd get bored relatively quickly of doing the same thing over and over again. And so the constant throughout my career has been one of, I think, building new things or building new businesses. And that's where I think I found the most joy and happiness in my professional life, and that tends to be highly correlated with where you do a good job. And so, credit derivatives early on became credit investing, became insurance, became being the CIO of an insurance company, became the president of being an insurance company and building an insurance company, and that then led to my role at Blackstone, initially in insurance, and then in building and merging all of credit and insurance together. So I think the constant throughout was one of kind of pushing beyond the boundary of what was right in front of me, and raising my hand to wanting to try new things and maybe being decently good at doing new things, and that was the kind of correlation throughout.
Yeah, no, absolutely. And raising your hand, I think this is definitely going to be one of the pieces of advice, I think, to the students in the audience today. So my understanding is that BXCI now manages about a third of Blackstone's $1 trillion plus assets under management. So tell us a little bit about that growth trajectory of that business.
Yeah, so the business today is over $500 billion, and the firm manages a little bit over 1.2 trillion. So even though people still think of us and call us a private equity firm, obviously we celebrated our 40-year anniversary as a firm last week. Even though it all started in private equity, credit is now one of the largest businesses by AUM. It's maybe not as profitable as private equity or the real estate business, but in size, it's up there. I think the journey for us in credit as a firm was initially around kind of like distressed credit or distressed opportunities in credit markets. And if you ask why, realize that in the early 2000s, our customers were institutional LPs. And what did they want? They wanted private equity-like returns in a variety of other asset classes that were adjacent to private equity. And so in credit, you had to go to distressed to generate those types of returns. And so back then, that's where it started. The firm acquired a business called GSO around 2007, and that became the kind of foundation of the business. That evolved over time into not just distress, but also having a leveraged loan business, a CLO business. And then in the last few years, I think really accelerated growth by pivoting from kind of our distressed roots to becoming what I call a one-stop shop lender across performing credit markets. So not really looking for high octane, high return with high kind of return variability, but more predictable, stable return generation across credit markets for our customers. That's really what our clients want in credit, and that's what we have today. So today we're active in liquid and private corporate credit. We're active in infrastructure and asset-based finance. We're active in real estate debt. So there's nothing we don't do in credit and lending markets. And increasingly, a larger portion of what we do is investment grade or high quality, high up the credit capital stack. And that pivots from kind of the early days of distress towards performing credit, inclusive of kind of a broadening of our customer base from institutional LPs to now include insurance companies and individual investors is really what's driven the growth.
So before we dive a little bit more deeply into some of these things, tell us a little bit about what it is like to be part of a private equity firm. Are there complementarities from the private equity business that are useful for the private credit piece?
I like to say I think it's our superpower as a firm, right? I think as an investor, what you want to have is as many data points as possible, right? That's where the edge lies. And by virtue of being a credit investor, if we were a credit business and that's all we had, and we were a standalone firm, we wouldn't have the benefit of all the other things that we can tap into at Blackstone. And I think the powerful ecosystem that the firm delivers is truly unique because we're an investor in private equity, obviously in our flagship core private equity strategies. But beyond that, we have a life science business. We have a tactical opportunities hybrid business. We have a growth business. We have our real estate business. We have an infrastructure business. And so whenever we make decisions or whenever we make loans, we force or tell our deal teams to go talk to the partners in the equity businesses that are relevant to the investment or the company they're financing. And it gives us a huge edge in not just understanding the model or the balance sheet, in front of us. You can do as much modeling work as you want. But if you have intel from the industry competitors, having been on the boards of these companies, having advisors that traffic in that same, say, industry lane, you end up making better decisions because you have more data points. And so we use that information as an advantage at the firm. We borrow heavily the intel and the underwriting benefit we have from our equity colleagues, and vice versa. They come ask us for advice when they buy companies, and I think that flywheel of information sharing at the firm, as we've grown and as we have many more strategies today than when we were just a private equity business, is what's really fueled, I think, empowered our growth, and it allows us to underwrite risk better and manage risk better. And we utilize it very actively. Not just whenever we make a new investment, but once a month, once a quarter, we get together with all of our group heads and we share what we're seeing in our portfolio companies. What am I seeing in our borrowers? What is Joe Barada seeing in his private equity portfolio companies? What is Nadeem seeing on the real estate side? And then we have a co-CIO model that helps our deal teams cut across all of that as well. And so the same people are in our investment committees to ensure that we utilize and kind of mine that information, and that we have processes to review it all in a very strict and regimented way, which allows us to do just that. So it's a long answer, but I think it's an important one that ties back to, as an investor, the more data points you have, the better off you'll be, and we are in a unique position as such as a firm to do just that.
Right, and maybe given the size of the credit business today, maybe a lot of that information now flows from the credit team to the rest of the firm.
Yeah, I mean, we finance over 4,000 non-investment grade borrowers, right, in our liquid and our private business. And so what we see month to month, quarter to quarter in those portfolio companies, gives us a tremendous amount of information. We finance consumer, equipment, commercial, digital infrastructure. What we see on the ground from those borrowers, again, gives us a ton of information on the other side of the business.
Right. So I'm fascinated about this migration from, what we in real estate would call opportunistic investing to core plus type of investing in the credit space. So I guess one natural question that prompts is, like, in today's world with bank versus non-bank credit, where does that leave the banks, and what is that relationship between the traditional bank lending model and sort of the more core aspect of your private credit business?
So I think the evolution of say opportunistic to core or core plus, in a way that's almost distinct from the kind of overlap with the banks, right? I think in a way, what that entailed for us was, or what drove that for us was responding to the need of our customers. If you think about the business we're in, right, an investment manager, and this is not just Blackstone specific, I think it applies to any investment manager, whether or not you're a public or an alternative asset manager. Ultimately, you serve your client, and what does the client want from you? The client wants differentiated performance, right? That's the North Star for our business. I think Steve Schwartzman, who founded the firm, likes to say we're analogous to a restaurant, right? If you serve good meals, people come back and come back for more, and they might try different things on the menu. You serve one bad meal, they tend not to come back. And so for us, that is the North Star of our business. So the kind of expansion towards performing credit in large part came in lockstep with a different customer base we started to serve. As we manage money for insurance companies needed different things than the institutional LPs that would invest in our drawdown funds, right? They wanted highly rated, investment grade, safe, predictable, high quality asset strategies that were generating, SOFR plus 200 or SOFR plus 300. Whereas, our institutional LPs wanted 12, 13, 14% net returns in drawdown fund format. So that evolution is what drove the pivot towards performing credit. I think the bank versus non-bank dynamic, is something that started in direct lending or non-investment grade sponsor finance at a time when post-crisis, banks were forced to have leverage caps on what they could finance They had capital constraints from tighter regulatory capital frameworks. And so a lot of the sponsors that were buying companies, other private equity firms that were buying companies, needed financing. And so the banks weren't able to provide it in the same way they provided it, say, pre-GFC or pre-2008. That created an opening or a void for people like us to step in and take advantage of the kind of direct lending opportunity. Now, fast forward to today, when a sponsor buys a company, they'll get a leverage read or they'll get a bid from a bank and they'll get one from a private lender. And they'll choose whichever one they want. One can have more flexibility, but might be a little bit more expensive. The other one might be syndicated and might have execution uncertainty, but they'll choose wherever they want to go. So I think the two coexist with one another quite well. As you go from direct lending, non-investment grade finance to performing credit, I think that's where banks are maybe a little bit less active in long duration, capital intensive businesses or things like digital infrastructure or commercial equipment finance or infrastructure. Those are harder for them to finance with a deposit base that's shorter because they tend to have longer duration and they tend to be more capital intensive. So I would say you pick your spots as to where you be complementary, but in general, I look at the amount of business we do with the banks. We have a tremendous amount of overlap. We're always going to coexist. There's going to be need for both models, but both models are quite different. And I think sometimes that gets lost when people talk about the risk of private credit or the risk to the financial system. I think people have a limited understanding of how both systems are actually complementary to one another.
And are there other relationships that you guys have with the banks that are symbiotic? Or
Yeah, I think there's many. I think we are a capital provider to a lot of banks. Today, we have flow lending relationships with a great number of banks where the banks will say, look, I have a set of customers, say a bunch of infrastructure borrowers that want to borrow money, but I'm limited to how much financing I can provide to them. But I want to continue to serve that customer because I'm interested in all the business they generate, capital markets, IPOs, and the like. And we may buy a portion of their infrastructure loan portfolio, and we may help them scale up those loans to bigger sizes than they could provide by themselves. And so we have flow relationships with a lot of banks like that. We will, from time to time, buy loan portfolios from banks that need to free up capital or that are reprioritizing where they want to grow. Some banks might say, you know what, I want to have less commercial equipment finance. I want to double down on the consumer. Others might say, I want to reduce my consumer footprint, and then we can help, right-size those portfolios. And then obviously the banks provide financing to us in some of our strategies where we run leverage. They finance us, and from time to time we may give them, SRT or other capital release solutions, as the case may be. So I think the amount of business we do with the banks is as high as it's ever been at the firm and within credit in particular. So it's highly complementary. We have great relationships, and because we're a large fee payer to the banks, we do a lot of business with them on the backside of this.
I guess the New York Community Bank was an example of such a in real estate land of a distressed.
Yeah, I think in real estate, we've done a lot, and I think beyond that, if you look at the kind of global picture, I would say banks are less capital constrained in the U.S. today than they were 1, 2, 3 years ago post the regional bank crisis, and when Basel III was likely going to get implemented without changes. Right today, that's going to get implemented in a less stringent way. So I think banks feel less capital constrained here. I think in Europe, banks feel more capital constrained. So we're actually pretty active with European banks right now in helping them right-size their balance sheets and being a good partner there. And I think in Asia, probably less so the case. I think commercial banks dominate most of their lending markets. So I think it's a different answer throughout time and in different places at different times. I think Europe versus US is an interesting prerogative right now on that front.
So you're the head of credit and insurance. I want to talk a little bit about that symbiosis between credit and insurance, right? So a lot of your competitors like Apollo have gone the route of buying insurance companies, right? And I guess something like 10% of life insurers are owned by asset managers today. You guys chose a different path of being more asset light. Can you talk a little bit about the costs and benefits of these two business models and what it allows you to do? And
Sure. Look, when I joined the firm 5 years ago, I think every bank or every investment banker out there, right, was advising us to go buy an insurance company. and buy a bigger one than all of our peers had bought because we were bigger. And that was the natural path. I think we studied that, but strategically felt it didn't really align with our DNA as a firm. Um, Everything we've ever done at Blackstone has been investing on behalf of our clients, and we've all done it organically for the most part over time throughout the last 40 years. And so the notion of, and we've done it in a balance sheet light fashion, not really using our balance sheet as much as maybe some of our peers have done to grow their private equity businesses. So the notion of using our balance sheet to go buy a big insurance company, controlling it, and then competing to a certain extent with some of our other insurance company clients that we had at the firm felt strange. And so we kind of decided to take a different approach. And we felt that if we built the right differentiated investment strategies that we thought would add value to insurance companies, and that we could go to them and say, look, CIO of insurance company XYZ, you have an in-house asset management model, or you have a third-party asset management model, but here's something you don't do, or here's something you don't have access to that we can give you access to. We felt that if we did that, over time, the clients would come. It'd be a harder way to grow because you'd have to grow one client, one CIO, one mandate at a time. But that's what we did. And I think it aligned well with historically how we grew the firm. And today we manage money for over 34 different distinct of the world's largest insurance companies. We grew that over 5 years, one client at a time. It's over $265 billion in AUM today. Started very small. We built it patiently, organically, one client at a time. But by having a good understanding of what they needed and mobilizing our scale and our footprint to then deliver into that, that was the way to go. And so it's highly customized. And what's interesting is we would have started with one client that gave us a mountain mandate. Today, all of those have grown the size of their footprint with us and or have added different things that we've created access to for them over time. So that organic model felt really good to us. Doing the balance sheet light fashion made sense to us because I think that's what we'd always done as a firm. And so there's merit to both models. I think Apollo and those guys have done a great job. KKR similarly in growing their footprint through an on-balance sheet approach. We like our model, and we think it'll stand the test of time. And there's no kind of like right or wrong way. But that's why we did it, in a different fashion than everybody else.
Right, makes a lot of sense, and certainly allows you to serve many more customers than if.
Yeah, it makes that discussion at the margin maybe easier than if you're selling product competing with one of your customers. But I think other guys too have found ways to serve a client base beyond their own captive in-house insurance company. We also felt that having that risk on our balance sheet, having hundreds of billions of dollars of insurance liabilities on our firm-wide balance sheet was an odd thing to do for our shareholders, and we've kept it lean, right? I think we're one of the capital lightest players in the industry, have no net debt outstanding, and that's why our market cap is the way it is, and so sticking to that was natural for us.
Sounds good. So I want to shift a little bit towards sort of the risk part of the story, and on that integration between insurance and credit, you'll sometimes hear people say things like, the insurance companies, as you mentioned earlier, used to invest in treasuries and corporate bonds, and now they're investing in CLOs and in sort of riskier credit products, and that puts ultimately the liabilities that they're owed to households at risk. So what's your view on that? This is sort of a risk-return trade-off, presumably.
And what's interesting is insurance companies have been investors in private debt for as long as they've existed. They're the biggest buyers or funders of private commercial real estate loans, on a buy and hold basis. Maybe the banks are bigger by size, but as an industry, their allocations to CRE debt have been high. They've been the biggest buyers or funders of 4-2 private placements, the kind of traditional privately structured debt pieces from corporate balance sheets. And pre-crisis, people forget they were the largest owners of a lot of the specialty finance businesses. that we've come to know that have then gone to banks and now are maybe being managed by people like us. So they did aviation finance. They were doing a lot of specialty finance in infrastructure. And so I think this has been an evolution where maybe they're doing a little bit less CRE, maybe they're doing a little bit less 4.2 private placements because those spreads have tightened a lot, and they've pivoted parts of those portfolios into this. I think the other trend that's occurred is that people have realized that the amount of what once was known as liquid corporate bonds, investment grade, high yield, EM, that one, post-crisis, those bonds are no longer as liquid as they used to be, and two, that you didn't need as much of that debt because your liabilities are quite long in duration and quite sticky, right? The liabilities of an insurance company is very different than the liabilities of a bank, which go in nanoseconds. On an insurance company balance sheet, you have the ability to, effectively monetize the fact that you've sold long duration liabilities by maybe picking up some spread by going from public markets to private markets and credit. And what people don't always realize is that, the shift to private, most of our clients want AA or single A rated, private credit, right? That's what we deliver for them. Not necessarily triple B, double B, or like below investment grade private credit. Initially, I think people thought that when we were starting to work with insurance companies, we were giving them access to our alternatives drawdown funds. We don't do any of that because there's almost no capital efficiency when it comes to that. So 98% of what we do for insurance companies is source single A rated private debt. So safe, predictable, well-structured debt, and it tends to be collateralized or backed by an asset. Whereas the bonds they're selling on the senior unsecured side in public IG, those are senior unsecured bonds. And so I think the pivot towards being secured by an asset, maybe giving up a little bit of liquidity, but getting directly or closer to the asset, we kind of call it, the farm to table model in credit, that allows them to earn 175 to 200 basis points of excess spread. And that's really what's been driving this. And what started with insurance companies has now spread to a broader customer base, right? Sometimes in financial markets, insurance companies were maybe last to innovation. Here, they happen to be first. Now, pension CIOs are saying, well, wait a minute. I too own a lot of fixed income. I too own a lot of liquid, corporate bonds. I too have long duration liabilities. Shouldn't I too allocate a little bit of my liquid fixed income portfolio to this instead? And that trend, I think, has really fueled the growth over the last 1 or 2 years. Where it started with insurance companies, it's now a broader based audience of CIOs that's taking advantage of
Maybe
this.
sovereign wealth funds as well.
Yeah, I think, pension CIOs, sovereign wealth funds, individual investors a little bit less so, but I think over time that might come too. But that trend kind of expanding beyond insurance and including our other institutional clients is really what's driven the growth that we've seen in our business. And I think in an environment where rates went from 0 to 4% plus, and now rates will go down likely again, the relative excess spread or the value of that excess spread is high. And that's why I think people are allocating the way they are.
So in the chapter of risk, there was a lot of noise recently about the First Brands and the Tricon bankruptcies. I'm sure you got your fair share of questions about that. I guess Jamie Dimon didn't do you guys a favor when he talked about the cockroaches, and if there was one, there's probably more. So what's your view on this? And should investors be worried about transparency in this space?
Well, I think what's interesting in those two names or in those situations is that all of them were bank-led, bank-originated, or bank-syndicated deals. And so it's interesting for Jamie to point to the private credit industry, but I think 80% or so of one of those names that was warehouse syndicated and placed by them. Look, I think we in situations like this, we tend to just look at and stick to the facts. And facts are that those are not companies that we finance in our private credit business, right? It's not what we do. All of them were private companies with individual owners and relatively limited disclosure as a result. 98% of what we do in private credit, whether or not it's corporate, non-investment grade or asset-based, tends to be companies that are public companies or companies that are sponsor-backed, i.e. underwritten by a private equity sponsor. And in non-investment grade, we tend to finance these businesses at 45 LTV. meaning there's 55% equity below us coming from a sponsor. They do their diligence, they do their work, we do ours on top of that. That's not to say we will never ever make a mistake, but that process is pretty robust, very different than when something comes out of the kind of like assembly line of a bank that places it in a syndicated fashion. So I would say in private credit, the facts as we see them or the performance as we see it in our portfolios today continue to be quite healthy. I think the macro backdrop is resilient. The growth we're seeing, you saw, I think at this point, 75% of corporates have reported earnings in Q3. Earnings growth continues to be positive. The economy, I think, continues to be resilient, and we're not likely to enter, a recession, even though we might see a slowdown in certain places. That's a very healthy backdrop for credit. Our non-accrual, our loss rates across our non-investment grade holdings are less than 10 basis points, so less than 0.1%. That's a tiny fraction of what you're seeing in public market leverage loan default rates. And so I think our process has consistently yielded, lower loss rate, lower default rates than public markets. And that's why I think investors continue to allocate to the space. That's a performance we continue to see. And so I think the noise out there was largely, misinformed, and this was not about private credit. That's not to say that you can't have default rates or loss rates tick up from here. But if you look at, even public market leverage loan loss rates or default rates are down 25% year on year or 35% over the last 2 years. So that resilience you're seeing on the macro side has translated into solid performance on the credit side. It might tick up from here, but I think you're coming off of a really low historical set of numbers that give a fair bit of cushion, to deal with headwinds from here. And I think because we're senior secured, because we're so low loan to value, we feel pretty good about what we own in credit right now. So it kept us busy because all the headlines generate a lot of inbound questions. But ultimately, if you stick to the facts, you realize that the noise was probably somewhat misplaced.
I see. So one other big trend, I guess a couple of big trends I want to touch upon. One is the data center boom, right? So a lot of private credit AUM was raised in the last 2 years. These data centers are incredibly capital intensive, right? Like Meta's Louisiana Hyperion data center is a $28 billion investment, for example. It seems like the private credit funds in general are pretty excited about this opportunity. So tell us a little bit more about that. I guess this is the hottest trend in real estate for sure, but maybe also in private credit. How do you guys look at that space?
I think it's real estate, infrastructure, and credit. And if you look at kind of any and all projections of how much CapEx is required to build this out, and I'm not looking at just the data centers themselves, but everything around it, right? The power that's required to support it.
Chips, right?
The chips, all the pieces. To build a 1 gigawatt data center, today you'd spend $15 billion on the building, and you'd spend another $35 billion to put all the stuff inside the building to make it work, and all the power and whatever around it. So 1 gigawatt is around $50 billion of CapEx. You can all do the math on how many gigawatts have been announced over the last few weeks and months. And so the number gets to a very large number very quickly. You're talking, $2 trillion was the initial estimate over the next 5 years. I think if you take everything that's been announced, you're looking at a number that's likely multiples of that.
Yeah. Morgan Stanley had like $3 trillion in the next 3 years.
Exactly. So I think even a conservative estimate means lots of CapEx. So when you look at, okay, what is that constrained by? 1, capital, and 2, power. So this will take every unit of power we have and or can dream of to power it, and it'll require any and all forms of financing to finance a CapEx. That means banks, non-banks, debt and equity. And so the good news is the hyperscalers that are driving most of the growth, right, are companies that are highly profitable and very highly revenue generative. And so when we look at building a data center at Blackstone, we own the largest builders of data centers with QTS in the US, and then AirTrunk in Asia, and Digital Realty. We've been at this for longer than just about anybody. We're not building anything on spec right now. So everything is contracted or fully leased. I look at the amount of compute that's being utilized in the world right now. There's not one unit of dark compute, meaning every unit of compute is being utilized, and the demand for it is multiples of what's available. And then you look at the revenue side of this, and I know there's a lot of articles about like this is a bubble, this is like the dot-com era, whatever. The amount of revenues that this will generate, if you look at the user base expansion over the last like 3, 6, 12 months, of the people that are using it at an individual level, you look at the corporate spend that will likely become revenues for these LLM providers as corporates adopt AI in a much more meaningful and organized fashion. You look at annual labor spend, right? $60 trillion in global labor spend. If we drive 10% productivity gains on the back of AI, which I think is a very low conservative estimates, that's $6 trillion right there. And so, that's an annual estimate. So I think people get lost in the large numbers and the big announcements and say, oh, that sounds like a lot, that sounds really risky. But if you peel it back and look at the facts that we see on the ground, I think we're relatively early still. I think the moment you start to see a lot of spec construction, the moment you start to see dark compute, or kind of like, compute and inventory that needs to find a user or a home, maybe things change. And historically, we've always, whenever these big trends occur, as humans tended to kind of like overbuild or provide overcapacity. This too might happen here, but I think we're pretty far away from it as we see it today.
Right. Sort of the other aspect of this is the degree of leverage, right? So I think right now, like Morgan Stanley had this $3 trillion number. About half of that is equity, about half of that is debt. Of the debt, only 70% of it is private credit, right? So we're talking less than $1 trillion of the $3 trillion in private credit. So maybe there's sort of a similar argument where as long as the leverage is sufficiently low, the LTVs are sufficiently low.
I think as long as the LTVs or the LTCs are in line, we're comfortable. And I think we obviously, not every data center is the same. Where it's built, how it's powered, and who the lessor or who the lease offtake is can be quite different. I think we love entering into financing arrangements with assets that are built in good locations that have access to power, and that are taken off by the existing hyperscalers that have a lot of revenues, beyond just relying on AI, right? Doing something with Meta, with AWS, with Oracle and the likes, those are really good credits in this environment. Despite the fact that they're taking on more debt, they're hyper profitable businesses. And so, you look at the market cap of those companies and you look at the security of the asset, you can construct a debt instrument that's pretty bulletproof. And that's what we like to do. But I think beyond just the data centers themselves, as a firm, what we've always done, whenever there's a big mega trend like this, we tend to look at the picks and shovels around it, right? One thing is to go build and finance the data centers. Everything around it, power, transmission, the renewable energy that's required, the components, the equipment, there's a lot of pieces of the overall value chain that need to come together. Sometimes you find better value by kind of being around the perimeter than in the kind of, box itself, where it's at. And so we look at it both ways, and we found tons of opportunities beyond just the data centers themselves. That we're pretty excited about. So we think this is here to stay. This will be big, and whenever we see something that's big, where the supply and demand of capital are not balanced, right? If you go back to like investor one-on-one, that's where you want to be, and hence we're spending a lot of time on it.
Makes sense. So you were talking about the productivity gains from AI. So just the last thing I wanted to ask you about was how does that manifest itself in your organization, in your team? To what extent is AI being used? Is it reshaping your workflow, the investment decisions you're making? Tell us a little bit about how that impacts your business.
Yeah, look, I think we've adopted a bunch of things at the firm that I think help us digest information, summarize information. We use it for simple compliance testing. Like, we're starting to use it more and more. I think that we haven't replaced ourselves with the bots when it comes to investment decisions. We still think there's a fair amount of judgment that's required, and we're not quite there yet. But it does make you, I think, a lot more productive. We're encouraging everybody on our teams to very actively use it, because I think I look at myself, how I was using it a year ago versus how I'm using it today is radically different. And we've asked a small number of young people across our teams to really think about this day in, day out and say, where can we really drive the biggest efficiency gains? There's still a lot of things we do manually. There's still a lot of things that we do that are, repeated tasks. That's all the easy stuff. But beyond it, how can we make our analysts, our folks more effective? I think that's what we're most focused on. It's not about replacing the humans. I think it's about empowering them to do more with the same amount of man hours. You and I were talking about this like a little bit before. They don't really, the machines don't go to sleep, right? You can empower them to read a tremendous amount of information, digest it, analyze trends across large data sets. We happen to have many large data sets at the firm, and you can do that overnight and walk in the morning, and as a result, be better positioned to go about your day and make better decisions. So I think we're all over this. I think beyond just kind of adoption in-house, the other thing that we're doing in our investment processes is really forcing our folks to think about the risks it will create when we buy a company or when we finance a company. The historical way of underwriting is probably not enough at a time when AI will disrupt a lot of businesses as we know them. So, for certain companies, it will create a tremendous amount of synergies and tremendous growth opportunity. For other companies, it might put them out of business, or it might take 2 or 3 other business lines and radically affect them, right? John Gray, my boss, talked about this at our CIO conference recently. We made an ad recently, which cost us, a fair bit of money to produce. You send people to different parts of the U.S. to film it. You come over the plot. You have lots of firms involved that help you do that. And then we created something, with 2 people indoors, by voice prompt and using AI. And it took 6 hours, and maybe it wasn't 100% as good as the ad that we put out on TV, but I'll tell you, it's about 85-90% as good.
Right.
And when you see something as that, you say, okay, well, that's today, right? You don't have to believe, that something meaningful is going to happen. That's hard to imagine in the next 1, 3, 5 years. You see that it will have a meaningful impact on a lot of businesses as we know it. And so we're trying to really think about that in our investment process very proactively, because it's the best way to risk manage against it. And I think public markets aren't quite pricing a lot of that in yet. And that I think could be an important driver of performance from here.
Great. I want to end with asking you just a question. We started out talking about our shared history at University of Ghent. There's over 300 students here at Columbia Business School. What sort of advice do you have for them if they're interested in your space and in the intersection of credit and infrastructure and insurance?
Look, I think I would say, be curious, and we find ourselves at this time when there's more information available about any of these businesses in the public domain than there's ever been before. More podcasts, more content. With AI, you can now access it and summarize it better than ever before. I think back to how we were learning about markets or whatever. You had to go get the book in the library and I don't know. I tell my kids that, and they're like, "You're old." That's all irrelevant. But I think the ability to learn about any one industry is better today than it's ever been before. And so, be a sponge, be curious, ask a gazillion questions, get access to people, and get access to content is the best possible way to learn about what path you might want to take. And then it's just about staying curious and working hard. I mean, to me, it always boils down to that. I look at, we're lucky to work at a firm like Blackstone. I think we have an amazing culture, but it boils down to a couple of really simple things, right? It boils down to caring about what we do and caring about our customers, caring about each other. We like to hire nice people. I don't care how talented you are and how much money you can make us. If you're not nice, you're not going to fit in at the firm. And if you do those 2 things and you work hard and you're driven, then you're on a good path. So don't overthink it. Keep it simple when it comes to that, and be extremely curious.
Great. I think Gilles has agreed to take a couple of questions, so I think we have a microphone that will circulate. So if you could raise your hand and then wait for the microphone. Yeah, maybe over here.
Hi, Gilles. Thanks for coming here and speaking with us. I'm very curious about life insurance and your experience at Global Atlantic, now at Blackstone. What I really was trying to understand is, I hear this demographic shift causing demand for life insurance to increase. Then when we hear the asset manager plus insurance model, I think we always refer to life insurance and not property and casualty, right? So just how big is the market? How much is it growing? How does it compare to a decade ago, if you will?
Look, I think it's a really good question, and there's a couple of things there. I think the demographic shift, right, is largely today playing out in, if you think about insurance, right, there's three types, or three main types. There's life insurance. I call it like catastrophe insurance for the individual, right? What happens if you die? There's the savings component, i.e. annuities, retirement. That's where I think the biggest growth is happening because of that demographic shift. And then there's the insurance of everything else around us, P&C, property casualty. I think most of the growth is happening in the retirement space. That tends to be the asset heaviest space of the three. And that's where, insurance is all about matching assets and liabilities. That's where the biggest, say, TAM or addressable market is for asset managers. That's why you've seen so many people buy retirement or annuity businesses or provide asset management services to annuity and retirement businesses. That's not to say that life insurance businesses can't benefit from it. They do, and there are clients too. It's not to say that P&C companies can't benefit from it. They too can benefit from it. The common thread throughout all of them is, if as an insurance company you sell a policy, i.e. you create a liability, and you invest the premium, as long as you make more money on your investment than you pay out over your liability over long term, you run a good business. So what we've seen is this pivot from public to private markets, largely because it gave people access to another 1 or 2% in incremental yield that allows them to then be more profitable and or pay a higher crediting rate or a higher rate of return to the end customer, right? Those two things, that at its core, that is what's driving this kind of cross-section of private credit and insurance businesses. No different than when insurance companies 20 years ago started to allocate to alternatives. They might only take 3 or 5% of their balance sheet and invest it in private equity funds or alternatives, but that too was about, excess yield generation. One company started doing it, they became more competitive, they took more market share, other people started doing it. Same thing happened here, right? 1 or 2 companies started 10, 15 years ago. Today, it's table stakes. If you don't have access to it, you will not be competitive in a product you sell, and or your returns will be lower. And that's really what's driving it. But I think it's interlaced across all parts of insurance. I think it started in annuities, it spread to life, and now P&C companies are more actively using these strategies as well.
May I just ask a quick follow-up question? For this big infrastructure spend that we see in the coming decade, do we need these flows from, call it life insurance or other allocators, LPs, or just the bottleneck is origination, as some of your competitors say, and not capital raising?
I think it's about more than insurance. I think it's insurance, it's pensions, it's all the kind of fixed income allocators. Insurance alone is not sufficient for the capex we're likely going to see. I don't think that in digital infrastructure the bottleneck will be origination. Maybe in some of the other strategies it is about origination. I think in digital infrastructure the supply of opportunities, or the supply of capex, and hence the demand for dollars, is a lot higher than the capital formation that has occurred so far. I think in maybe other parts of the market, it's a bit more origination constraint. In digital infrastructure, I don't think origination is the constraint.
Okay, let's take another question.
Hi, thank you so much for your talk. I had a question. You kind of touched upon the edge of like banks versus non-banks. Now that Basel III is sort of like being edited and banks sort of re-enter the credit market, what would you say remains structurally more advantage in terms of like the credit system for non-banks and your competitors in Blackstone in general?
Look, I think banks being active or not, even when Basel III was on the table and was on the path to being implemented, banks were still active. So it wasn't as if banks kind of completely disappeared, right? I think at some point maybe we took more market share post-COVID than the banks did, but I think the banks have always stayed active. I think capital rules will still go up. They won't go up as much as what would have happened if Basel III was implemented without change, but the direction of travel is still higher, which means banks will still run with slightly less leverage than before or more capital to support their existing systems. And so, look, a bank is on average 12, 13, 15 times levered. And they have deposits that can go away in a nanosecond, right? Like we're less than 1 times levered. You know, we raise money from large institutional LPs that have buy and hold horizons that can't like disappear, and we do that in structures that don't have liquidity. So you know they're matched with the asset and they're less than 1 times levered. That's a good thing for the financial system to have access to both. The reason why a borrower would choose a bank versus say a private lender today, it can be manifold. Sometimes a sponsor will call us and say, I'm running a confidential process. I want execution certainty. I need a quick response. I need to know that you're there for the financing. And in that case, they'll pick a private option over a public option. If they have a lot of time, they're less worried about execution risk, they have a sanguine view of markets, they might choose a slightly cheaper syndicated option. If a sponsor wants to do a large, complicated carve-out, that will be a better fit for people like us than for the bank. So the answer can be different at different times. It can be based on market conditions. It can be based on the structure or the complexity of the deal. It can be based on the sponsor's willingness to take execution risk or not. What I mean by execution risk is you go to a bank and you say, okay, well, where's the financing? They're going to say, we're going to give financing at a spread of X, but there's flex pricing because if it rains outside the day that we have to actually raise the financing, we might price it wider, right? When they get a bid from us, they know what the number is, they know what the terms are, and hence the execution certainty is there. So it depends, and today you still see all of the above, if you will.
Any other questions?
Up there.
Gilles, sir, thank you for your time. So my question is about extreme weather and how is that affecting insurance in places like Florida, Texas, California. So places are becoming more unaffordable just because insurance premiums are skyrocketing due to environment. So I guess my question is, how is Blackstone thinking about this long term, and how is that going to affect, or is it a problem at all? So I just wanted to get your thoughts on that.
Yeah, look, I'll caveat it by saying I'm not a P&C expert or a weather expert. What I can tell you is that, look, the reason why property and casualty insurance is a lot more expensive today than it was 5 or 10 years ago is because the incidence, it used to be that people would say, okay, we're going to insure to like a 1 in 100 year event. And then these 1 in 100 year events started to happen seemingly every quarter or every year, multiple times a year. So I think people had to recalibrate their models and charge more for that. So the incidence of these events went up. You can debate what the reasons for that are, but a lot of consensus exists, obviously, that those are weather related. And two, that happened at a time when, through COVID, but also, beyond just COVID, through inflation in general, the replacement cost of the assets went up. Real estate values went up. Construction costs went up pretty meaningfully. And so you had this like double whammy of premiums going up because P&C companies needed to get paid more to take on the risk, and the replacement cost and the insured value going up. And it's hard to see that slow down. I think in a way, at Blackstone, we invested in a couple of situations that if you will, took advantage of that. That said, it's hard to predict whether or not that will last for a long period of time. Typically, when those situations occur, a lot of capital comes in, rates of return go down, cost of capital goes down, premiums go down. This might take longer to right size or normalize, but eventually it tends to do that. Markets tend to be pretty efficient. It might just take some time.
Great. I would like to take the last second to thank Gilles for a wonderful conversation.
You're welcome.
Please join me in thanking him.
Thank you very much. It was a pleasure.